All right, so just getting a question from Juan on what we're talking about. So the topic today is going to be how to unlock collateral by tokenizing real-world assets. So basically, each of you, I'll let you introduce yourself quickly when you get to a first question. But basically, the first thing I want to answer is maybe to our friends from Maple, to Martin. You guys have, kind of like issued about 8 billion in loans since you just since your inception. Most of that has been backed or over-collateralized by ETH, Bitcoin, and blue chip crypto. I think recently you added some staked ETH from EtherFi, Lido, and so forth. Question I have is, let's assume Robinhood gets to scale and we have tokenized equities on chain. Is that something you will accept? You see that as a trend? How will that play out in your strategy?
Yes, yeah, thanks, Nicolas. So I'm Martin, head of growth at Maple Finance, on-chain asset manager. That's an excellent question. I think ultimately, if you really look to the long term, all assets are going to be tokenized, right? So all stocks, bonds, real estate, everything ultimately will be tokenized. That's obviously a very long-term vision. And what you see in TradFi is that over-collateralized lending against those assets is extremely common, right? It happens all the time with investment banks. Especially high net worth individuals and funds just borrowing against their equities. So that's definitely going to happen on-chain as well. It's going to be a lot more efficient. The cost of capital is going to be better for everybody because it's going to be a more open system. So how we think about it at Maple is, we don't tend to go out on the risk curve too much, right? So we really accept blue chip collateral. So we will, sort of wait a little bit on the sidelines and see until some of these assets have reached a certain level of scale. And there's a couple of things that are really important for us, like the liquidity and some of the things with the oracles, like what happens in the weekends, right? When equities aren't trading on the traditional exchanges, like what happens on chain, right? If liquidity is pretty thin, so that's a thing that needs to be solved. But yeah, we're extremely excited about it, and it's just huge to see companies like Robinhood, come into the space and do such a big announcement. So we're big fans, and we're definitely gonna be accepting those assets over the next 6 to 12 months.
And Martin, maybe a quick follow-up there, kind of like how do you go about selecting that collateral, right? Like let's assume you have equities on-chain, kind of what's important to you guys, like, equity, volume, kind of all of that. What are kind of like the key parameters where you'll filter on to first adopt them or put them on the platform?
Great question. Yeah, so there's sort of 4 factors that we really look at. The first is what is behind it, right? So sort of what is the company behind it? Does that company have a chance of going down 80% overnight, right? Because it's like some really speculative startup. But if it's a company like Google or Amazon or Meta, obviously it's very solid, right? So it's a very solid asset, similar to Ethereum or Bitcoin. So that would be the first step. Then the second step is what is the liquidity profile of the asset, right? So of course in traditional finance it can be very liquid, but what if there is a liquidity event on the weekend, right? Is there enough on-chain liquidity? Do market makers accept it? Like can we hedge it with perps? Like sort of what are, the liquidity parameters? And then we would look at the volatility of the asset. So, how volatile is it over time? And, what are sort of the LTVs that we can set? So initially, it'll probably be a lot more conservative, right? So, maybe there's like a 50% initial LTV. But over time, as we better understand prices and we have seen trading through a couple of volatile events, right? Like that will all build a track history that we can then build our models on. And then finally, it's also concentration risk, right? And sort of, looking at that and, the less concentrated, the better. And I think, the main thing that we're extremely focused on right now is just the oracle question. So what happens during the weekend when traditional markets are closed? Are market makers accepting it? Looking at a couple of the panelists there. And yeah, like how do you solve that part of the equation? I think is a fascinating question and is one that I think we're going to answer very soon.
Maybe that's a good segue for you, Juan. And if you don't mind quickly introducing yourself first, but again, taking that same example, right? Equities on chain, they don't trade over the weekend, maybe OTC, whatnot, but is that something with Keyrock that you guys would support, would enable? Obviously DeFi is 24/7, right? So if it's used as collateral, needs to be able to get liquidated over weekends. So we'll need market makers basically plug into that. Is that something that you guys already see? Do you get those questions? Would you support that? Curious about kind of like making that into or turning that into action.
So my name is Juan David. I'm the founder of Keyrock. Keyrock is an algorithmic trading market maker. To answer the question, it's actually not the first time that this is happening. The industry has been faced with these issues of like over the weekend cutoffs already for a while. In the past few years, there's already been a very good trend in terms of tokenization of commodities. You know, like gold has already been tokenized and it's starting to acquire, capitalization in the digital asset market that is big enough, and is also actually quite hard to trade the asset against the hours in traditional finances. And it really comes down to question of risk. So we've been actually, I think now, honestly, maybe 4.5 years trading tokenized gold and trying to issue it against traditional gold houses. And it really comes down to risk profile, correct? Like on the weekends, we would expect spreads to widen because there is not capacity to hedge that, but it just becomes a statistical or mathematical problem that you can model. The assumption, especially at the beginning with tokenized equities, is that majority of the users would be more in the retail space. And so we don't think it would be a major issue. We don't think some large traditional pension funds would be taking advantage of this to like dump their position over the weekend or something like that. And even if they would, it would just get to a risk level, and then I guess at that point liquidity will run out. But most probably won't. I think it will be fine. I mean, at least we are ready. I think the hurdle is not on the market making side at least.
Got it. And did you already get some questions, from clients, for instance, that want to use that? I mean, gold, for instance, as collateral, right, or other kind of like more traditional tokenized assets or real-world assets on chain. Is this something you offer already, or those types of collateral basically at Keyrock? Does that enable some strategies, some trading strategies?
I think the point here is indeed like to your point, liquidity is the value proposition of tokenization. If you tokenize something and that something is not liquid, why do you even bother? Correct. And the reason that liquidity is important is because of the utility that it gives. So we are now tokenizing all these RWAs. Why do we do it for? If we tokenize debt, if we tokenize equities, if we tokenize commodities, is to give it added value, added use. That added use comes, from the most basic use cases at the moment, which are, can it be used in money markets? Can it be used as collateral for trading? Or can you actually build enhanced yield into the product? And as long as you can do those things, then it will be useful. I think when it comes down to tokenized equities, I would think probably tokenize ETFs, if they are well integrated within the landscape of money markets and trading collateral, will be more useful at the beginning than single name stocks.
Got it. I guess the second point, and it's more, I'm looking at you, Niklas, that Martin highlighted is obviously kind of like to put traditional assets on chain, you need a lot of information, right? It's not only about price feeds, there's kind of like volume data, debt, liquidity, all of that. Can you talk us through kind of like what the biggest hurdles are to enable that from an Oracle perspective, focus specifically on that?
Yeah, I mean, absolutely. So I think that's kind of the biggest difference between decentralized finance, right, and with this introduction of tokenized assets, is that in a DeFi context, I think oracles have always kind of been perceived as, oh, here's this kind of service that gives you a price. But with the introduction of tokenized assets, and Martin, right, I think you touched on this, right, is there are other pieces of data, right, that are equally important to do kind of responsible, appropriate like risk management. And while this risk management can be done manually, I think in a lot of places in crypto, right, it's done manually right now. This is not scalable, especially as we are getting in the sizes of tens of billions and seeing kind of 1 billion plus allocations into these positions. And that's really where having this specialized kind of data streaming infrastructure comes into play. We've kind of built this. I think traditionally Chronicle has always been kind of one of the largest oracles in the DeFi space, right? Coming out of MakerDAO with with close to like 10 billion of TVL. But when it came to tokenized assets, right, we really had to like throw everything away and start from scratch just because of the breadth of data that was kind of necessary. Now, I think your question was like, what are these pieces of data, right? We had already discussed, right, that there are trading hours, right, and okay, what do you do on the weekend, right? I think this is more a perspective of liquidity, right? What is the ratio of liquidity that is being traded on the weekends during, you know, non-market hours, right, versus what is the liquidity?
It's quite small even in crypto. Like
sure.
There's a lot less.
Absolutely, right. I think we're the panel beforehand, right? I believe it was Hilmar from Arrakis, right? That suggested that we are not too far away from a scenario where on-chain liquidity, right, could actually be greater than the off-chain liquidity. I agree that we're not there yet, right? But these are the types of things that we have to pay attention to, right? And so. Liquidity is definitely one, right? If you are a decentralized financial kind of credit allocator and you have a $1 billion position, what pieces of information are important to you, right? Maybe you want to know, like, am I able to unwind my position, right, with minimal market impact, right? And so now you need to have some kind of real-time data stream telling you, well, what is the liquidity, right, available off-chain, right? What kind of market impact would it have, right? Can we unwind the position in 1 day, in 2 days, in 3 days, right? And the kind of DeFi protocol can react in an automated way to kind of balance its exposure, right? I think yield optimization is also top of mind, right? As the breadth of kind of tokenized asset products increases, right? I think you'll kind of see the velocity of money being much quicker in an on-chain capacity than you see in an off-chain capacity. I think you'll see DeFi protocols rotating in and out of positions rather quickly, right? Depending on where the best risk-adjusted return is. And I don't think kind of I think this will come as a bit of a surprise to kind of the traditional financial institutions who are used to kind of from a BD and growth perspective, right, pursuing, you know, allocation, right, from a certain capital, you know, entity, right, only to then be surprised in a DeFi context that, well, maybe 2 weeks later, right, they've already rotated out again, right? So I don't want to ramble on for too long, right? But there's certainly a considerable breadth of information here that is relevant, that will enable DeFi protocols, right, to automate the risk management and exposure here.
Got it. Maybe Max, looking at you at PVO1, kind of like your mission obviously is to bring bonds on chain, right? And you kind of like started with a bond to a market maker, B2C2. Can you talk us through kind of like that process? I know there's a collateralized vehicle, I think, with blue chip assets, but how do you see that evolve? Were there discussions about bringing other assets on chain? I mean, I'd love to kind of like unpack that and understand kind of like how the discussions were at that point.
Work now? Yes, all right. A quick presentation. My name is Max Boonen. I am at a small tokenization startup called PVO1. And before that, I was at B2C2, one of the main dealers in crypto. As Nicolas said, we issued a few bonds on-chain directly with B2C2, and we are working on a new one that is secured by crypto collateral. When we say issuing on-chain, it means that you send your stablecoin into a smart contract, you get minted a token, as you do for any other DeFi platforms, and then the token that you get is a bond, so you can transfer it permissionless, and at the end of the time, the duration of the bond, you go back to the smart contract and you get your interest plus your principal back. It's very simple, the economics of a bond, except that it's on-chain with your MetaMask wallet, etc., etc. I think what's important here is two things. One, we want to do another one which has crypto collateral. So when we talk about unlocking collateral, I think it goes in both directions. The first one is that there's lots of unused collateral in crypto that you want to be able to use to raise capital. The dealers, such as Keyrock as well, they're very fond of that because they have typically excess crypto collateral and needs for stablecoin or fiat funding, especially in times of high market activity. So the ability to use crypto collateral to raise funding from within crypto or outside of crypto, that is quite important. I think there's a big trend there that crypto is going to be used more and more as collateral, is going to be more widely accepted. I think the Trump administration just signed some executive order a week ago saying that they're going to force the 2 federal lenders to accept crypto for mortgages. We'll see what the details are there, but it's going in that direction for sure. So that's one thing. The other thing, when we talk about tokenization, is typically the other way around. It's okay, well, we want to tokenize Amazon stock or S&P 500 ETFs, and we want to use that inside of crypto. Now, the title of the panel here is to unlock that as collateral inside of crypto. So it would be, I have a tokenized Amazon position, and I want to be able to leverage that inside of crypto in DeFi to borrow USDC. I feel like it can be a little bit like putting the cart before the horses, because the number one thing that we need to do first is to solve a problem of market access. Because to me, and the big effort that Robinhood is doing in tokenization, is that first and foremost, we have to accept that in crypto, we are lacking in financial products. We don't have access to enough financial products. Of course, we can buy Bitcoin, Ethereum, we can swap them, we can do all sorts of things, but it's always around the same assets. And the first step, the first time we broke through, is when we were able to get stable coins in crypto. That meant that you didn't have to be exposed to crypto prices within the blockchain ecosystem. You could say, and we used to say, oh, he went back to fiat, or he went back to stables. Yeah? He didn't want to be exposed, he just went into stables. You have to realize that back in the day it was very difficult to do that, because if you sold your crypto, they were sitting, your fiat was sitting on an account at an exchange, but it's very difficult to take back into the fiat system because of the AML KYC issues that we still have today, actually. And so having stablecoins really sort of solved that. You could take your stablecoin of the exchange, could do some other stuff with it, and then tokenized money market funds and T-bill products came into the market, yet increasing what we can do with our crypto. So now you can earn yield on your stablecoins, but at the end of the day, that's pretty limited. I mean, first of all, they're always short-term overnight deposits, typically for 1 day. What if I want to lock in 2-year T-bill rates? I can't really do that. And that's just the very beginning. Like having access to fixed income risk-free products is the very beginning. So it's really important that we don't have to go back to the fiat system in order to invest in financial assets. And I think that enabling the tokenization of stocks is a great step in that direction. Now, what I think it means also is that I don't think that all assets are going to be tokenized, but I think that a lot of them are going to be tokenizable, or they will exist also in tokenized form. Because let's be realistic, there is absolutely no need for a big asset manager like PIMCO or the big pension funds to buy tokenized equities. They just buy the real stuff, they buy the equities, because they have access at an institutional level to those markets. But the little guy, it doesn't work like that. So I think that we're going to see something more like a parallel system where we're going to be able to hold our S&P 500 ETF in tokenized form, not necessarily because it's more efficient or something like that, although yes, it's cool if we can trade on the weekend, but honestly, actually, weekend trading in equities has existed for, I think, a decade at the margin brokers like IG, eToro, etc., so it's not really something new. But I want to be able to hold my S&P 500 ETF on the blockchain because I don't want to deal with the banks. That's the reason why. I want to take my Bitcoin, if I want to sell, I sell it, I get some Tether, some USDC, and I want to be able to put that into an S&P 500 ETF. To me, that's the very first steps we need to solve. Then, later, if I want to buy a house with my holdings and I want to get a mortgage on the back of a tokenized financial asset, let's do that, yeah? But first of all, it's a question of market access.
Yeah, maybe just to respond to that, I think you have some good points there. So I think the key here is what is the actual use case, right? Like, why would people own these stocks on chain? It's great that they're on chain, but what is the actual use case? So I see a couple that I think are really going to take off. So the first is private companies, OpenAI, SpaceX. I mean, everybody in this room probably wants to own those companies. And everybody in the world, right? Like if you think about if you're a hedge fund in China or in Hong Kong, or if you're just a retail investor like us who's excited about technology, you want to own those companies. So I think that's going to be a killer use case that's going to take off. Then another one is, a lot of volatility in the real world happens over the weekends. So this is something I realized recently, but a lot of politicians, they make, high impact market decisions on Friday evenings, right? Because then the market can digest it over the weekend. So imagine if you're a hedge fund and you have to fight for every single basis point of performance, like you're going to be setting up a team that's going to be trading over the weekends on tokenized equities, right? Because there's a lot of new alpha there. There's going to be a lot of volatility, bigger spreads, aka opportunities. So obviously you need liquidity for that, and that's going to take some time. But those are, I think, two. And then the final one is the more obvious one, which is just people in emerging markets getting access to the great companies that they cannot really access right now. So those, I think, are sort of the three areas I'm most excited about, where I see real adoption happening the quickest.
And maybe a broader question for each of you, kind of like, where do you see the big unlocks, right, with that collateral? Is it mostly kind of like an access point, like you were, alluding to, Max, that you don't need to get back to fiat? Or is it either like that collateral will unlock better rates because you open it up, there's more liquidity, it's a broader market? What are the efficiencies tied to that specific collateral?
Maybe I'll take this one. So, I mean, one of the things that I find very interesting is that when you look at this concept of access, what does it really mean? So you have all these assets, you have the stable coins, you have now the tokenized funds. What it really means is that not only for the user this is better, but for the capacity for startups to be created that are more innovative. This is something that is very interesting. If you look in Europe, what happened with the fintech sector after the creation of the banking open API standards. It was very interesting, correct? Because all of a sudden you have access to build financial innovation that has access to everything. So the thesis here is that the same happens, where all of a sudden you are outsourcing a lot of the complexity of onboarding users to someone else. So if I create a on-chain application and people can just come with their stablecoin, even with Mika, correct? Just come with their stablecoin and they use their stablecoin without KYC. What that actually means is that I outsource my legal cost to the onboarding party, correct? Kraken or Binance or whatever. Yeah. The same thing with more complex products. And so all of a sudden, you start to take a lot of complexity out of the system, and that generates the barrier to entry for new players and for innovation to be much higher, because not only they have access to the world, so instead of having to build something where it's only for French consumers and attached to how the fuck you get these French consumers onboarded, now you can onboard the whole world, and not only that, you don't even have to actually take care of that legal hurdle, because you're outsourcing all of that to the tokenization engine, which is very interesting from the point of view of the creation of innovation, and I think that's actually why ultimately is gonna end up creating even better use cases that we don't understand today.
Any other thoughts on that point?
Yeah, I mean, to me, you mentioned accessibility, right? Accessibility is the beginning, but it's really what does accessibility lead to, and it's my belief, right, that if you give everyone access, these will become the most liquid markets in the world, right? And as they become the most liquid, right, they will start becoming the driver of pricing. Right, everything else follows, right? The momentum will shift on chain, but in the immediate term, in the short term, right, it really is just access, right? We don't get that liquidity for free. It's going to be fought for with blood, sweat, and tears.
Got it. Maybe thinking that through from your different vantage points is kind of like, what are, in your opinion, kind of like the best forms of collateral that we can bring on chain right now, next to the classic blue chip crypto, right? BTC, ETH, whatnot. Do you think it's stocks? Do you think it's real estate? Do you think, well, what type of assets do you feel like will, unlock the most, or should we start with as an industry?
I have an example. At my company, we're working on a deal where a well-known hedge fund wants to lend fiat into the crypto ecosystem, and they're potentially happy to receive crypto collateral, but it needs to be structured in a certain way because they can't actually really touch the Bitcoins in a normal wallet. It's not in their mandate. What they're looking to do is to receive one of the Bitcoin ETFs. So they're comfortable with the economic characteristics of the asset, whether it goes up and down, whether there's a chance like jump to default or something like that. But it's a question of, again, kind of like access, but the other way around. We tend to talk of access for, how does the little guy have access to those products? It's also a question of the institutions. How can we give them access to that type of stuff? So Bitcoin as an asset for collateral is actually, widely accepted in terms of its underlying characteristics. The question is the specific format doesn't always work. So in that case, it's kind of like the other way around. Just like we were talking of tokenizing Amazon stocks on chain, we're also sort of like reverse tokenizing Bitcoin for the institutions so that they can have access to that. But the important thing, you mentioned that if we remove the buyers, liquidity will aggregate where it's easier to access the product, right? And that's why you think that DeFi is going to become like the biggest market in the world because of that. Well, the reason that it's also interesting for that hedge fund to do that trade is because there's a massive market for the financing of securities. In fact, it's an ARB. If they take the Bitcoin ETF and they lend at whatever, 6%, on the back of that, they can finance the Bitcoin ETF at 5% because their prime broker, CT, HSBC, Goldman, is going to finance that at like treasuries plus 75 bips. So there's a really interesting piece there where we have that opportunity to bring a lot more financing into crypto, but only if we can turn the collateral into an asset that's palatable to the lenders, not in terms of does it go up and down, but in terms of the actual format.
Yes, very interesting. Go ahead.
Yeah, maybe I have actually a slightly different view, but from a point of view of, especially when you're like a large trader, and Max probably would experience that as well, is that very often you also just care a lot about the asset being widely usable. Like USDC doesn't have yield, but you can send it anywhere. Like it's accepted everywhere, and that's important. So the perfect collateral asset, in fact, would be something, and it doesn't exist yet today. I'm kind of working on figuring this out, but it would be some sort of like a stable asset, which is referenced to whatever you're trading on as a base quote asset that is widely accepted, and that it gives you rights to yield. Not yield in a tokenized format, but rights to yield, because what you actually want the value of the collateral to not change, if possible. So a stablecoin as is the best thing that you can have. If you can have that stablecoin giving you the yield paid somewhere else, that would be even better. That would be great.
It's true that in TradFi it's a mess. You always have, when you get collateral, you have to send any income you get back to the beneficial owner. So we have in GMSLAs, GMRAs, all those big agreements, they always say, well, if you get a dividend, you have to send it back. But what happens if you get withholding tax on the dividend? It's a mess. So the idea that you can get paid the yield somewhere else actually would solve a lot of problems.
That would be awesome. That would be the
and
best.
actually, you can bridge to different addresses, right? You bridge stuff, right? And if I bridge USDC from Ethereum to Arbitrum, on some bridges I can say, actually, I want the output not to be back into my wallet, but another wallet. So the plumbing is there.
Plumbing is there, definitely.
And I guess maybe a last question. I see we only have a minute left. Is you guys all deal with institutions, right? But Maple, Oracles, you guys as market makers, PVO1, have you ever needed to, with borrowers, kind of like refuse certain types of collateral that you feel like we're getting very close now for you to accept them? And if so, which types of collateral and why did you have to refuse that up to this point? And talking from an institutional perspective, right, kind of like the unlock that comes.
We would very rarely not accept collateral if it has liquid markets. Like it's a matter of liquidity. Like if an asset, I've never heard of it, token ABC, has perps and it trades, let's do it. It's okay.
Does it need to be on chain or can it be any?
No, it doesn't. It just needs to be liquid.
Okay, that's it.
It's true, 100%.
What about
from the money markets point of view, there is a different view there.
Yeah, so we have rejected assets in the past. Like we tend to be a little bit more conservative in terms of assets that we accept. But I definitely fully agree. Like liquidity is king, so that's the absolute key. And then maybe to your earlier question, just time is up. like maybe to your earlier question, I think the other very important thing to remember is that Robinhood is now in town, right? And they're going to be distributing this through their application, which I think is going to be huge as well. So their application is really good at sort of gamifying finance, simplifying it. It's very easy to do options and do call overriding and all those different financial strategies that are quite difficult to understand, but they make it very simple. So I see a world where Robinhood sort of plugs into the Aves and the Maples and other protocols and offers all these products, right, to borrow against your stocks, and it's just powered by Aave in the backend, and the user doesn't even see that, right? So I think that's also a very exciting future and definitely a massive area of adoption of these products.
Awesome. Well, I think our time's up, but thanks a lot, guys, for your time and the great insights.
Thank you very much, Nico.